Someone You Should Know. A program about people you know and even more that you don't. Hosted by Stuart Sax, veteran, husband, father, and grandfather. Now, here's your host, Stuart Sax.
Well, I welcome you again to another edition of Someone You Should Know. Here we are at the end of another year. Can you believe it? Getting ready to go into 2022. I just don't know where the time goes. It's just flying by. But I know there's a few things that you have to look forward to in 2022, and I'm going to tell you about a couple of them because one of them involves one of our sponsors, and that's No Sweat Experts. Right now, you're getting ready to go into 2022, and you know we're going into some cold weather, so you might want to make sure that that heating system is working. You call the folks over at No Sweat Experts. They'll be out promptly. Take care of the look going over your entire system, get you all set up, filters changed, get you going. And also plan for the new year to upgrade your marketing. How? With DFW Networking Diva, Christine Dean. You know, somebody did call me the other day and say, yeah, I heard what you said about Christine, but I don't live in the Dallas-Fort Worth area. As we say on the southern border of Texas, no problemo. You can call Christine, set up a conference call with her, and she can take care of you wherever you are. If you're in Seattle or you're in Miami or you're in Maine or you're in Southern California and all places in between, call dfwnetworkingdiva.com. Get all the information you need. Contact Christine. She can help take your website, your marketing plans, your business, and everything to a new level in 2022. Now, what else do you have to plan for in 2022? Tax returns. So to talk about what you got to do to get ready for the new tax season, I brought in a good friend and our expert at tax preparation, Robert Gralla.
Hey,
Robert, how are you?
I'm doing fantastic. So it's so nice to be here. I'm so excited. The new tax preparation season's coming up, coming January 1st. I can't wait to get started and dig in and help all my clients file their tax returns.
And you are probably the only one. You're anxious to get into it, and everybody says, oh man, I got to go through all that paperwork again and get it ready for my accountant, but
yeah.
It's what they call a necessary evil. And we are at that time of the year. It's the end of the year. And since there are still a couple of days left in this year, I think one of the first things that I would throw at you is what can people do in order to shelter whatever money they got this year and not have to pay too much in taxes as they start to prepare the taxes after the first of the year?
Great question, Stuart. I'm so glad you asked, because that is the question that everyone wants to know the answer to. What can I do before the end of the year to save money in taxes for this year? Well, usually the strategy to save taxes is to accelerate expenses and postpone income. With that said, that opens up a whole broad spectrum of how do I do that? On individuals, if you itemize, there's a couple of things you could do to lower your taxable income. First biggest thing you can do is charity. In other words, everybody likes to give to the local church, civic organizations, whoever, charities that people want to donate to. Accelerate some of your donations this year or give more this year, or actually give this year if you were anticipating giving anything next year. So in other words, give as much as you possibly can before the year end so you can deduct that on your current 2021 taxes. And if you itemize, that will lower your income. And you're going to give the money anyway. You might as well give it now to save money on taxes.
Well, and you might as well give it to that nonprofit who can really put it to good use rather than giving it to the government. Maybe I shouldn't have said that, but we know that's true. Yes. Now, how does the average Joe go about doing that? If he says, okay, I know by my pay stubs and everything about how much my income was. And maybe you can figure out if you've got investments in stocks and bonds and stuff, you can, if there's capital gains, and get a rough idea. And is there a formula that somebody can do to say, okay, this is about what I think my income was for the year, and my tax rate is
Right.
this. So this is what my tax is going to be. However, if it shows that I'm going to end up having to pay $3,000 in taxes, do I turn around and then say, okay, I'm going to make $1,000 donation to 3 of my favorite charities,
Mhm.
and that'll normalize it?
Well, the formula you can use is pi r squared minus the radius of a subtriangle on the isosceles basis times the hypotenuse.
Okay,
More
carry
realistic.
carry the one, and okay, I
More
got it.
realistically, you can do a rough draft of what your tax return would be. You can look at how much your income is, your W-2 form income, interest, dividends, any capital gain, any business income, less your itemized deductions, and come up with a rough idea of how much you're going to owe. Also, look at last year. Look at what you earned last year compared to what you earned this year, and see if there's any big variations, any big differences between last year and this year. And you can kind of come up with a number. A lot of my clients, what they'll do is they'll contact me come the beginning of December. They'll give me their last paycheck stub and tell me approximately how much they're going to make in December. They have a lot of their brokerage information, and we could do a rough idea, a rough draft of what their tax return will look like. Of course, it's not 100% because nothing is 100% at this time. There's always a couple of curveballs that are thrown. Things change a little bit, but it'll give you a very good idea. Especially, for example, if you have somebody that got a big raise, took on a new job this year, that could have a significant impact. Let's say you made a lot of money in the stock market in 2021. That'll have a big impact. You got married, you got divorced, you had children. All those things can impact what your taxes will be for 2021. If you're a little bit uncertain, best thing to do is contact your CPA, your enrolled agent, your tax preparer. Let them run a couple of scenarios for you to see where you stand with your taxes. Another thing people could do is they can pay 2 years of real estate taxes in 1 year to save. Now, we're limited, though, with $10,000 of total tax expense as an itemized deduction. So once you go over $10,000 for real estate taxes or state income taxes, you're limited to that $10,000. But let's say your real estate taxes are $4,500 for a year, $5,000 a year. So if you combine the two of them in 1 year, you might get over the edge to itemize, over the limit or the threshold to itemize, and be able to save money that way as well. So it's possible you could double your real estate taxes in 1 year, pay zero the next year, and you can actually save taxes by doubling on your real estate.
Okay. Really, because I just got my real estate tax statements, and of course,
right.
it usually if you pay it either in full or you pay it make payments, it'll
right.
say the first payment is due by January 31st.
Right.
So what you're saying is when I take those tax papers and I give it to the accountant and he says, okay, here's what the taxes are that you're going to be paying.
Mm-hmm.
You can give him what you already paid in 21 and what you are being billed for in 2022, as long as you pay it in 2021.
Yes, as long as it's paid in 2021. Now, please understand, this may not help everybody, but it's something that you should be looking at when you're looking at doing your tax return. You can get an idea if it'll help you by looking at your prior year or your prior 2 years tax returns. You can see if that will help. Another good strategy, let's say you work for a company and you have a big bonus coming in the year end. Well, you might want to say, well, let's postpone that bonus until next year. Let me make less money this year. And next year, kind of worry about it then, what's going to happen next year. Obviously, if you know taxes are going up, you don't want to take that bonus in the next year. You want to keep it in this year. Also, by taking a bonus, it might not only lower your taxes, it'll lower certain thresholds so you can get more of your itemized deductions as well. But once again, this is something you need to speak with your tax professional to see how it will affect you. It might help, it might not help, but it's something that you definitely should look at.
Well, so the reverse could be true too, is if you've got this year-end bonus and you had some issues this year, whether it was pandemic related or whatever, and you had a loss Maybe you lost in the stock market. Maybe you had other losses because you were laid off periodically. Then you might want to say to the boss, "Listen, boss, could you make the bonus effective the 31st of December?" And
Yeah.
and that way
Or
I
you can
can
ask for the
claim it
next
as
3
income.
years worth of bonuses.
Okay. Now, what if you're self-employed? Do you
Well,
do the same thing? Do you do the same thing? Do you determine whether you're going to give yourself that bonus or something at the end of this year or at the beginning of next year?
it depends what your business structure is if you're self-employed. If you're a sole proprietor and you can't postpone how much money you're going to make this year by taking it out of the business or not, because when you're self-employed, for example, you file a Schedule C,
Right.
whatever money you've earned, whether you take it out of the business or not, is income. On the other hand, if you have an S corporation, well, that would be kind of the same because any money that's earned by the S corp is distributed to you as well. You see, the thing is, most taxpayers on what's known as the cash basis. What that means is the money that you receive for sales or for income is reported in the year that you actually receive the cash. So let's say you have a big sale coming up at the end of December and you don't want to pay tax on it this year. You can ask the person you're making the sales to if they could pay you next year, within a reasonable amount of time. Obviously, it all depends on when the cash, hits your account. I mean, you make a sale at the end of the year, they don't pay you till next year. It's income in the next year. That's a whole other business strategy
Right.
that you can work on with that. It's interesting, Stuart. You mentioned about writing off stocks to reduce your income. Now, there are some strategies that work and some strategies that don't work with that. For example, if you have a large capital gain this year for 2021, and it's a long-term gain, you could write, or short-term gain actually, you could take any of your stocks that are losses that you're never going to make any money with, take the loss this year, and you can take those losses against all of your stock gains. However, very important, if you only have losses, you can only deduct up to $3,000 of that loss per year. For example, I lost $50,000 in the stock market in 2021. Well, guess what? I don't have any gains. All I can write off is $3,000. The benefit is, though, you can carry forward the $47,000 until you use it up for as many years as it takes to use up. Another example is, let's say you made $50,000 of gains in the stock market and you had $60,000 of losses. Well, you can take the 60, write it off against the 50. So now you have a $10,000 loss and you can take $3,000 of that. The other $7,000 you carry forward. And capital gains are taxed at a little bit of a different rate than regular income tax. Long-term, short-term capital gains are usually taxed at current income tax rates, whatever bracket you're in. Long-term rates are usually different. You have a 0% bracket, 15%, and a 20%, all depending on what your income levels are, what you're going to be taxed on for capital gains. You're usually lower than the ordinary income rates. So once again, write off some of those losses against any gains in the market before the year end, and you can save money in tax that way.
And one of the most important things, I think you'll concur with me, is make sure you keep records of everything.
Yes.
I this time of the year, I have a designated drawer in the guest bedroom that is the files, and that's where I put the tax files. That's where I put any kind of investment information, medical bills and payments, religious, nonprofit, everything. Keep it together, and keep all of those notes, because two reasons. Am I correct? Number one, it helps you prepare to go through and see what you are entitled to and maybe what you're not entitled to, but also keep those records for at least 7 years, because if for any reason there is an audit and they say, well, wait a minute, you said you donated $2,000 to this, prove it, show it to us.
Exactly. Now here's the thing about keeping records. There's two things you need to prove to the IRS if you get audited. First thing you got to prove is that you actually had the expense, or you actually had the expense. Number two, that you actually paid the money. A lot of people will say, well, I'll just save my bank statements. That'll show I had the expenses and I paid them. Well, that only is part of the equation. The bank statement or a credit card statement or a canceled check will show that you made the payment and when the payment was made. That doesn't, however, say what the payment was for. In other words, let's say I go to Staples and I buy a bunch of supplies for my own personal use, and it's on the receipt. Okay. And I pay out of my business. I get it audited. The IRS would want to see the receipt. They go, well, this isn't business. This is personal. But if I had it all paid out of, it was all business expenses, and I show them the receipt that it was business expenses, things I use in my business, they can't deny that. And I can also show the fact that it was paid. So two things you need when you get audited is a receipt to show that what the expense was for, and a bank statement, a canceled check, a credit card receipt, or a Venmo or something to show that you actually made the payment. But anyway, I just want to say one other thing. Talking about keeping your records. I'm sorry, Stuart. I know this is your show. I just talk a lot too.
No, that's why you're here, is to make sure that whatever I say is factual,
yes,
and reasonable.
It's always factual and reasonable. You never go over the line. But it's important, again, your medical expenses, your charitable contributions, and all the other expenses that you might have. You keep that for, if there's fraud or other defalcations, that could be up to 7 years, but good business people keep records for 7 years. And it's important because in case you get audited, you have the receipts, and also to show your tax preparer that you have these records, and also to help add up everything, because you don't want to go to your tax preparer with a bunch of receipts. You want to add it up beforehand, don't you?
Right. Exactly. And having said that, let's zero in a little bit on the medical stuff.
Okay.
From year to year, the tax rules sometimes change. In other words, if I go to a dermatologist just because I want my skin to look nice, maybe that might not be covered by a health insurance plan, or even if some of it is, do I have the right to say, okay, it was $300 for the visit, and insurance paid $50. I'm on the hook for $250. Do I claim that $250 as a medical expense?
Yes. Basically, the rule of thumb is out of pocket expenses. So in other words, you paid $300, you're reimbursed $50, your actual out of pocket expense is $250. That's what you're entitled to deduct. You're also entitled to deduct your cost of medical insurance as well. Now, if you work for a company and they pay your medical insurance and it doesn't cost you anything, you cannot deduct that. But let's say there's a split at work. Let's say, I'm just going to throw a number out there. Let's say your medical insurance costs $15,000 for the year. Your company pays up to $10,000. You can deduct $5,000 of that on your tax return. Now, here's the thing. There's another hurdle that you need to jump over to deduct medical expenses. If you itemize your deductions, you can take anything over 7.5%. So 7.5% is your threshold of medical expenses. Excuse me, let me retract a little bit. 7.5% of what they call your adjusted gross income, not medical expenses, but your adjusted gross income. I'm going to throw a number out there. Let's say your income for the year is $50,000, your adjusted gross income. Your 7.5% is $3,750. So all of your medical expenses over the $3,750 you can deduct. You have to eat the first $3,750.
Okay.
So let's say your medical expenses for the year came out to $10,000. Your adjusted gross income is $50. Your 7.5% is the $3,750. You could deduct $6,250 of medical expenses in that case. That's on a personal return if you itemize. Let me switch around a little bit. If you're self-employed, you can deduct your portion of your medical expenses under certain circumstances. Certain ways you can, certain ways you can't, but this is where you need to speak to your tax person. if you're self-employed, you can deduct what they call above the line from your gross income, the cost for your medical insurance. And that's a big thing because you don't lose 7.5%. If you don't itemize, you lose it all. So if you're self-employed, Schedule C business, partnerships, S corporations, you can deduct that amount of your medical insurance from your gross income, which is a big deduction for you.
Now, what happens to those people that, for one reason or another, were partially employed last year because either they were furloughed, they were laid off from a job because of the pandemic, then they were called back, later in the fall to work, and all. They've had like you said, well, look back to maybe 2020. And compare. If you've been in a situation where you have lost money because of wages or because of other issues, maybe you got some unemployment benefits or so. How, what are the reasons that you should keep meticulous notes on all of that in order as to how that could affect the taxes that you're going to pay? And I'll throw into that also the stimulus checks that everybody got.
No.
Was that free money, or you have to claim that as income?
No, the stimulus checks are free money, period. It's not income, period. Okay. It's free money the government gave you.
Yeah, I'm just trying to I'm trying to think now. See, in my position, I'm retired and I'm also a senior, so I'm on Medicare and I also have a Social Security check that comes in every month. It's pretty easy for me to figure out what my annual income is because it's more or less a fixed income. The only thing that changes a little bit is is an investment portfolio that will go up and down a little bit. But how should I or someone in my position and all attack this preparation at the end of the year to go forward on my taxes?
Well, number one, a lot of people that were affected by COVID and their employment, obviously, if you made less money, you're going to pay less in tax. And there were certain business incentives to keep employees on, employee retention credits. But on the personal side, you got your stimulus payments, which are non-taxable. Last year, for 2020, if you received up to $10,200 of unemployment insurance per person, was non-taxable. So let's say you applied for unemployment insurance, $10,200 of what you were paid is not taxable. Normally, unemployment insurance is taxable. So, and if you had business losses.
That's where that loss carried forward can come in.
Yes, you can carry it back depending on what year the loss was for, 2 years, possibly 3 years. For example, let's say you had a loss in 2020, and let's say the carryback period was 3 years. So you can go back to, 2017, take that loss, push that onto your 2017 tax return, file a certain form with the IRS, and if you have less income at the end than what your taxable income was, you can get a refund. Or in certain instances, you can carry that forward and lower your income in future years for whatever that amount of the loss was. If you had certain types of business losses, net operating losses. And it's kind of complicated how you calculate it, so we'll just call it a net operating business loss for simplicity.
We talked about earlier a little bit about figuring out what your taxes might be so that you maybe can defer some of that tax hit in the form of a donation, let's say, to a nonprofit.
Right.
What if somebody says, I did pretty good in business this past year and it looks like my income is up a bit. Can I gift some of that money that I have earned maybe to my son and my daughter, or even though they are not a nonprofit or something, but I could say, you know what, I did well. I'm going to give 10,000 to my son. I'm going to give 10,000 to my daughter. Do I reduce that tax hit now by $20,000?
Okay, it's a good question, and that question really has two answers to it. The first answer is, in order to take a deduction for a gift, it has to be to a recognized charitable organization. In other words, a church or another organized charity.
Yeah.
And let's say, and it gets even more specific. You need to, when you donate it to a church, it's got to be generally to the church, or if they have a specified type of a fund, a building fund, a grounds fund, a pastor,
program, right.
a priest, rabbi fund. But if you want to make a donation to a church or a synagogue, and you go, I want this money to go to a certain congregant, you can't deduct that. It's got to be generally to the organization itself. You can't deduct money given to an individual unless the individual has a foundation or they have their own charity. You find a homeless person and you go, I want to give you $100 out of the goodness of my heart. That you cannot deduct because that's to an individual. If you gave the money to an organization that helps the homeless person, you could deduct that. Now, getting to your children, you want to give your children a gift each year. You cannot deduct that on your income taxes, okay? The only way you can deduct children is if they are your dependents, or you have medical expenses if they're your dependents. Sometimes you can deduct medical expenses if they're not under certain circumstances. You get childcare credits if you pay for childcare if they're your dependents. But in general, a gift to your children is not deductible on your tax return. However, gifting to children, if you have a taxable estate, will reduce your taxable estate. And you're allowed to gift to your children, or gift actually to anybody that you want to make a gift to. One individual can gift to another person up to $15,000 a year, tax-free, without paying any gift tax. Did you know that if you give somebody more than $15,000 a year as a gift, anything more than $15,000, you as the donor have to pay a tax on the excess of the $15,000. So you can give each child up to $15,000 a year. In fact, your wife can give each child $15,000 a year as well. So let's say you have two children, you can give up to $60,000 a year without paying any gift tax. You give 15 to the child, your wife gives 15 to the child. You go to the second child, you give 15, your wife gives 15, total of 60,000. So yes, you can give people money up to $15,000 a year tax-free without paying gift tax. And also you cannot give anybody any gifts and take that off on your tax return as a charitable contributions, because you're just not allowed to do that.
All right. So now the other side of this discussion is, I give $15,000 to my son. I give $15,000 to my daughter. Do they have to claim that $15,000 as income because dad was good to them?
Well, the first thing I'm going to do is I'm going to contact your son and daughter and tell them they're both getting $15,000 gifts. That's the first thing we're going to do. The second thing is, when you get a gift from somebody, you're the donee, the recipient of the gift. There is no tax on your behalf that you need to pay. So you're kind to your children. You give them a gift up to $15,000. There's no tax that you pay. They receive the gift. There's no tax that they pay.
Okay.
The only thing is, if they put that $15,000.
Excuse me, the phone's ringing. I think it's my son and my daughter calling.
The only thing is, once they receive the gift and they put that into some sort of earnings account, interest bearing, dividend bearing, or whatever have you, any earnings on that is then going to be taxable to them.
We talked about donating. For instance, donating clothing, donating goods, donating furniture. Whatever you donate, do you get a receipt from the place that you donate it to? And is that taxable? Is that deductible on your taxes? Because I kind of heard that, yeah, it was, but there's a threshold, so you have to donate more than this. Otherwise, you're just giving it away to get rid of it.
Well, there is no threshold. Okay, you can give away $1, you can give away $100,000. There's no threshold per se as far as how much you're allowed to give away. Okay. Like anything else, it's when you give away money or goods, as we call it, to charity, In order to deduct that, you have to, be able to itemize on your tax return. You can't take a standard deduction. Although this year you can take up to $600. If you don't itemize, a married couple can take a charitable contribution if they give cash. But getting back to your question, you can give clothing, you can give electronics, furniture to a charity, and you can deduct what they call the fair market value of the goods at the time of the donation. What is the fair market value? There's a list of things out there by the Salvation Army, by Goodwill Industries. You can go on their website and you can find what a shirt would be worth. Fair
Right.
condition, good, excellent. What a pair of slacks would be worth. What an old computer would be worth. And things like that. And you can deduct that on your tax return as well. One other thing, though, all of your charitable contributions, there's a limit, though, of how much you can deduct on your tax return. You can deduct what they call up to 60% of your adjusted gross income. Let's put that into real numbers. Let's say your adjusted gross income for the year is $100,000. That's basically income, dividends, stock, business income.
Right.
$100,000. The most you can deduct and get a deduction for in the current year would be $60,000, 60% of $100,000. Any excess you can carry forward for up to 5 years. So there are limits to how much you can deduct for the amount that you give away to charity. Make sense?
Yeah, and I'm glad that you addressed that, because I had kind of heard two stories. Somewhere along the way, somebody said, if you donate a bag of clothing to Goodwill, let's say, you should write down 3 shirts, 4 pair of slacks, 2 belts, and put in what that fair amount is. And if it adds up to $300-400, fine.
Right.
Then somebody else says it doesn't really matter, because it's just a flat rate. You could just say I gave them $500 worth of clothing in the bag, and you're going to have to donate to a certain level before it is claimable against your taxes. So there's kind of two versions out there. Which one's accurate?
Okay. Technically, what you should do when you donate a bag of clothing, you should itemize each item in that bag of clothing. A lot of times people will take a standard amount of $50 per bag of clothing. Okay. It's a general, a standard amount. But technically, the correct way to do it, you need to itemize every item that's in that bag of clothing. I donated 3 men's belts, 2 pairs of women's shoes. Not my shoes, someone else's shoes. Okay.
Right.
5 shirts, 3 pairs of slacks, a suit. You need to itemize all of that amount on. You don't have to itemize it on the tax return. You need to itemize that. Keep a record of what you donated. And normally what will happen is you'll get a slip from the charity you donated it to. And on the slip, you can itemize that, come up with the total, and you can put on your tax return. Donated on June 1st, 2021. The Salvation Army value $350, because you have the backup for that $350 where it came from. And there's no limit to how much you can donate. You can donate $1, or when I set up to 60% of the adjusted gross income, you can donate more, but you can only deduct up to 60%. So you can donate $1 of cash or goods, or up to $1 million, or whatever your limit is for cash and goods. No limit on how much you can do.
The average Joe like myself, relies on people like yourself to keep up with all of the changes that are going on from year to year. Yes. Are there any changes going into 2021 specifically that people should be aware of as they start to prepare their 2021 taxes, and then also to start preparing their records for the 2022 year?
Okay, good question, because there's always changes going on. What we spoke about during this conversation so far was mostly what to do for 2021. I mean, the tax rates are pretty much set. We've done pretty much what we can, a couple more things we can do. However, one caveat, with this new Build Back Better plan, or the government in general, can always pass tax changes retroactive. So right now, 2021, we have our tax laws, we have our rates. The government can always forward in 2022 retroactively make changes to 2021. And they did that actually for 2020. So let's concentrate a little bit more about what to expect for 2022. I think that's more of a better discussion at this point. What's interesting is the government wants to hire, the latest number was about 85,000. The IRS wants to hire 85,000 more employees on the audit side to audit more
Wow.
businesses, individuals and businesses. Personally, I think they need to hire more staff on the administrative level side because we deal with them on the administrative level, and there are huge, huge backups right now. When you try to call in on a practitioner's hotline, it's ridiculous amount of time that you have to wait. There's a couple of million, I don't remember what the number was. I was at a class last week and they discussed it. A couple of million tax returns from 2021 that have not yet been processed because they're still sitting in trucks at the IRS office. Yeah, they need administrative help if they need anything. But the idea with the current administration is to hire more auditors because they want to audit everybody or more people and try to get more tax dollars from these people. So that's one thing that we might look for next year is more cash businesses will be audited. Another thing that's very interesting, if you do business and get a credit card, use credit cards rather, the credit card company will not send you what they call a 1099-K form unless you have more than 200 transactions or you receive more than $20,000 of income or receipts. 2022, that's changed. That $20,000 number now is $600. What does that mean? A regular business, it doesn't matter because they're reporting all their income. But what about these people that do garage sales? You have a garage sale and, how are you going to pay me? Well, I can take a credit card. I can take Venmo. I can take Zelle, PayPal, all of that now, $600. So you had a garage sale and you made $800 selling junk out of your garage or out of your house because you're moving. The IRS is now going to see that you made $800 and you're going to have to explain to them where that money came from. So that's a big change that they're doing with these 1099-K forms. And we're not very happy about that because it's a lot more reporting that really doesn't need to be done. And if you do enough garage sales, they're going to say, well, you're self-employed. That's another 15% in tax. And then the state is going to come in and go, we want our money in sales tax as well. It's a whole can of worms that they're opening up with that.
Wow.
Yeah. It's interesting also, there's a very important note. The Consolidated Appropriations Act, which went into effect December of 2020, they made entertainment expenses, or rather meals for businesses, they raised it from the 50% deductible level to 100% deductible, which was for 20 and 21. So for 2020 and 2021, normally you take someone out for a business meal, you can deduct only 50%. But because the business industry, the restaurant industry took such a hit with COVID, they wanted to do something to stimulate it. So they let people write off up to 100% of their meal expense instead of 50%. That runs out at the end of this year. A couple of other interesting changes. They're trying to raise certain rebates, certain refundable tax credits to help individuals, going forward. For example, they have something called a child tax credit. You have a child under 17, you automatically get $2,000 as a credit on your tax return. 2022, that's going up to $3,000 per child under 17. And if your child is under, I made a note, it was 5 or 6, under 5 years or under, that $3,000 is now $3,600. So a few years ago, they did away with what they call exemption amounts. You had a child, you got a $4,000 exemption,
Right.
$2,000 exemption. So they increased the child tax credit to make up for that. So now, last year, the child tax credit was $2,000. It's going up to $3,000, up to $3,600 for a child under 5 years and under. What they also did was, if your credits and payments were more than your tax, your child tax credit, you lose. In other words, if you got $2,000 and you didn't owe any tax, you didn't get the $2,000. They made that now refundable. So if you owe tax, if you don't owe any tax, you're going to get that money back anyway. So instead of it being lost, you're going to get the money back. Child tax credit. Child care credits, in other words, two married couple, both spouses work. you get a credit on your tax return for childcare. You pay a childcare provider X amount of money. It went up from 35% to up to 50%, and the threshold went up also as well from, I think it was 4,000 to 6,000, and went from, I remember what it was last year. This year for 22, it's going up to 8,000 for one child, 16,000 for two. So technically, you have one child in childcare. You paid $8,000. You're going to get back $4,000 in the tax return for that. So the child care credit went up for 2022, which is good.
I dare to say a lot of these things that you're talking about, people are totally unaware of, and that's why you need a professional tax preparer to tell you that this is what you're entitled to, because those people, excuse me for using the word TurboTax, and say, well, I'm just going to buy a program and plug in everything, and that'll tell me what my taxes are. You're probably going to miss out on a lot of these things that you're entitled to because you're not aware of what those changes are.
Yeah, exactly. But you know what's interesting? I don't want to knock TurboTax. They do ask a lot of questions when you're preparing a return.
Yeah.
And if you have a simple return and you follow all the questions, chances are you'll get your tax return at least 90% correct. When you have a complicated return,
before I forget,
yes, sir.
If you don't pay off a credit card each month in full, then you get a finance charge. Each year, you make a mortgage payment on your home, and there is interest on that. You have a car loan and all. Are all of those finance charges and interest charges on all of those loans and credit cards, those are still deductible from your taxes?
I'm going to give you the standard answer that tax preparers give to people I've asked that question, or questions similar to that. Yes and no.
Okay. Yes.
Mortgage interest on your principal residence, a secondary residence like a vacation home, you can deduct. There are certain limitations when you go above $750,000 or $1 million for the home. There are certain limitations, but you can deduct 100% of your mortgage interest if you itemize your deductions. Credit card interest, many years ago, you used to be able to deduct credit card interest as an itemized deduction. They did away with that. I think it was in 1986, the big tax law change in 86. You have a car loan. Car loans, you can't deduct the interest on that. However, if the credit card is a business credit card used for business expenses, then you can deduct the interest on that. Same thing with a car loan. If the car is used for business and you take actual business expenses for your automobile, for your business, then you can deduct the interest on the car loan. So mortgage interest, yes, on a personal return. Credit card interest, car loan interest, no, unless it's for business. There's a lot to know.
It's a lot to know, and it just goes to reiterate what I said at the very top of the show. You need to have a professional to talk to. And I know you certainly can take care of anybody in Texas. I think you need to know now's the time to hook up with your tax preparer and start saying, what records do I need to bring to you?
Yes.
What records do I need to keep? What ones maybe I don't need to worry about anymore?
Yes.
Because this is the time of the year right now, year end, when you need to know what you're doing.
Yes. I have on the back.
I wanted to go through the whole show, and then I wanted to touch a little bit about what you do when you're not preparing taxes, and I never got to it. So I'm going to have to schedule another show sometime, because you and I share something, and it's a love of comedy.
Yes.
And it is improvisational comedy, as well as you are doing some stand-up comedy. Yes. And it's I don't want to just spend 1 minute talking about it. I'm going to have you back on another show, and we'll just tell jokes.
I just will say this. Yes, that's a great idea. Okay. Burns and Allen, the Marx Brothers here.
There you go.
Yes, you and I both share the love for improvisational comedy. What is it they say? Say yes, and your world is an oyster. Improvisational comedy, the secret is just say yes, agree with the person, and go forward. I love improvisational comedy, watching it and performing it. I also love stand-up comedy. And I've been in a couple of stand-up comedy shows, and I do a lot of open mics in the Dallas area. A lot of fun. I love it. So much fun.
And I agree. Plus the fact that especially when you're in the kind of profession that you are in, to be able to walk away from that office of preparing tax returns and everything, and then say, I'm going over to the comedy club and I'm going to stand up and do a 5-minute routine.
What? Why are you kidding me? Well, my clients in my office, where do you think I get my material, and where do you think I practice it?
Yeah, well, true, but don't some of your clients sometimes say, "Hey, is that true, or are you joking with me?" Is that real for real?
I got a phone call one time as a business referral. Someone had my number. They didn't remember my name, but they remembered me as being very funny. So I pick up the phone. I go, "Hello, Robert. This is Robert Gralla. Can I help you?" And they go, "Are you the funny CPA guy?" That's my reputation.
And your answer was yes.
I said, "Hold on, let me see if he's in."
Yes. Can I help you, or can I help you, or can I help?
Can I help you out? Well, which way did you come in?
Right. Well, Robert, thank you very, very much. I hope that people not only will watch the show, but they'll go back and rewatch it too, because there's a lot of information that you have given them throughout the show. We've been scrolling the phone number and the email address where you can reach Robert. If you've got questions, reach out. Don't let those questions go unasked, because it could cost you money.
Yes.
Better to get those answered by a professional and know, so that you might find out, there's an extra few $1,000s that I can deduct from my taxes.
Yes.
Thank you, my friend. The very, very best to you. Happy and a healthy new year ahead. And one of these days, I'm going to meet you up on the stage and we'll share a mic.
I look forward to it. Thank you very much, Stuart. It's been my pleasure.
Take care. That'll do it for another edition of Someone You Should Know. And again, Happy New Year to everybody. Come back again next week. It'll be a brand new year, and we'll have a brand new series of shows for you. Take care. Be well.
Someone You Should Know.